All right, yield nerds, for what it is worth, the 99th episode, so that's exciting. I've made it this far, and I'm still happy to share what I learned. This time I thought I would talk about resisting the fear of missing out, because I do have that fear. And my yield game plan for December 2023. We are up to 236 subscribers. Look at that. We added 9 in the last month. At that rate, in 8 short years, I will be at 1,000 subscribers, and YouTube will pay me 10 cents a month for all this content I create. How exciting. Couple things, we're about 15-ish months old, so we're a relatively new channel. And if you're joining just now, please consider using the playlist, which is in sequential order. And hey, don't believe what I say, do your own homework. Speaking of doing homework, remember this is not investment or tax advice. You make decisions. I'm not pitching any product. I don't care what you buy or don't buy. I'm not a wealth management advisor, and I certainly have no business telling you what politics or policy or product you should buy. Well, let me recount what I see. This is the last 3 months in the market, and it just is stunning. Stunning is to say the least. This pits Nvidia, Microsoft, Meta, and the S&P. And as you can see, it is a party out there for those stocks. The S&P in aggregate went down by as much as 6%, but it is up 4.5% in the last 3 months. Some of the other ones in the Magnificent Seven are up 16, 17, 20%. Unbelievable. And that is because they are all counting on a soft landing where inflation is tamed, unemployment is not too crazy, and interest rates are going to go down magic, and that is what they are counting on. And so, I guess that is one perspective. Uh, I will say, you got to give credit where credit is due. Inflation is indeed coming down. And the funny business about how it is computed, as long as the rules are kept the same, is you compare year over year. And so this shows the conceptual idea that if we had 0% price increase between this month and last month, all you would see is a 1.2% inflation. That is unbelievable. And we could literally afford another 0.2% of price increase. And because we are comparing before and after, we would still come to 2%. So believe it or not, December 12th, 13th, when the CPI comes out, it may create a huge Santa rally, as they call it, because the Fed may say, we did it, we are at 2%. And part of it is because inflation was as high as 9%. It's on the way down. Everything looks good because you were under tremendous stress. And so who knows? But based on this, I kind of thought, gee, should I be developing some fear of missing out a potential rally? And I keep thinking about the next FOMC meeting, middle of December. The odds are very high based on that mountain shape you saw that inflation CPI will be lower. It may touch sub 3% and the market may celebrate. Unemployment is likely to be slightly higher, as you can see, eliminating seasonal employment. Regular employment numbers may come in lower because of some layoffs that you can read. There is also the very, very high likelihood that the Fed is going to leave rates unchanged. They certainly aren't going to increase it. I don't think so. I don't think they are suddenly going to decrease it. But all of this put together, the middle of December through the end of December may create an insane uptick in the market. If I was a day trader or an options trader, I'd probably roll the die, but I'm going to stay true to my core. And here is my extremely terrible slow poke portfolio. And the last 3 months, it made 1.5%, except there is a misnomer. It showed almost 0.8% increase just today. Hey, my portfolio doesn't do stuff like that. That is because, thank you, Schwab.com, I do have several FHLB and FFCB bonds, and those pay 6.5% yield state tax free. And given all of this exuberance about a soft landing, a lot of these FFCB and FHLB bonds are getting called, and Schwab has a data error where they will put the money in my account and still leave the bond in my portfolio, which is incredible, but that is what they do. So it artificially shows when those FHLB or FFCB bonds mature, it shows that suddenly money is falling through the ceiling, and that is not true. So my return for the last 3 months have not been impressive at all. I'm just kind of, you know, staying in the same water. Just to kind of keep you abreast of how I invest, I am very, very heavily in fixed income, within that into treasuries. I do have some value stocks, and then I have some bank loans and securitized debt, but not a big portion there. So, having said that, I ask myself the question, should I develop the fear of missing out and jump into these magnificent seven? Am I missing out here? Is something going on? So I started doing some research. And so I am going to compare companies that people would argue should not be compared. I'm going to compare NVIDIA and Apple with Chevron and Cord Energy. Hey, you know what? I'm allowed to compare what I want to compare. You do you, remember? And I can see the allure. NVIDIA's profit margin is 42%. Chevron is a mere 12%. I can see why there's a lot of enthusiasm around NVIDIA. And I see Cord has a pretty respectable 28%. And so I'm going to sit here and say, gee, I wonder what else is justifying these huge valuations. And I go to earnings per share. NVIDIA makes 750 and Cord makes 3 times that, almost 4 times that. Chevron makes double that. You sit there and go, wait a second, if earnings are lower, shouldn't that have a lower PE ratio? Apparently not. Nvidia trades at 61 on PE ratio, meaning $1 in Nvidia earnings is worth 61 bucks. This is the world's most interesting man. His 2 cents is worth $38. Look up that ad. It's a pretty funny ad. So Cord Energy's $1 in earnings is worth $6, but Nvidia's $1 in earnings is worth $60. Hey, you do you. That sounds bogus to me. Look at cash flows. Nvidia's $1 in cash flow is worth $195, and these value stocks, it's a dollar to dollar. And you sit there and go, interesting. And the price to sales, 25 times their sales versus 1.5. And then I started looking at profitability and I said, aha, I see why NVIDIA has this huge profitability here, 70%. Oh, wait, Cord has 60%. It must be the net profit margin. I see it now. The net profit margin of 42% versus these paltry net profit margins. That is why we should all pay $165 for $1 in cash flow, until I looked at the cash flow itself. The cash flow per share is $8 for NVIDIA and $38 for Cord and 20 for Chevron. I would love to hear from listeners, if you own NVIDIA, why you think $1 in their earnings is worth more. Is it a different kind of dollar? I don't know. Educate me. And then I started learning more about cash flow and profit, asking the very simple question, can a profitable company go out of business if they don't have good cash flow? Surprise, surprise, of course. Cash flow is king. Profit is important, but cash flow is king. And for me to be asked to pay 190 whatever dollars for $1 in cash flow, you do you. I am at peace in the value corner. I am not jumping. I do not have the fear of missing out. It seems like irrational exuberance to me. And I'm borrowing from Alan Greenspan there. So what lies ahead? Well, there is this whole debt ceiling debate, and there is a lot of questions about, will there be a shutdown, will there not be a shutdown? And I looked at what the debate is about, and in FY23, fiscal year 23, we spent 1.6 trillion. The House wants that to come down to 1.5, give or take. The Senate wants it to be even higher than 2023. And look at how cool this sounds. The Fiscal Responsibility Act shaves a little bit of hair. So the end of the day, we're just off by 100 billion between friends. And I sat there and said, is that really the difference? If that is the difference, maybe there will be a compromise, maybe there won't be. But at the end of the day, does the shutdown matter to a yield investor? So I asked the question, what if there is a shutdown? It will be bad news for equities. And hey, I'll see if I can pick up more value stocks. Maybe I don't have to pay $190 for every dollar of cash flow for some of these superstars. And the bear will be in full action. It'll be a winter bear festival if that happens. If there is no shutdown, we still have to refinance a huge amount of debt. If that is news to you, you should watch the previous episode where there is a wall of debt that is coming up. And what will happen if more debt needs to be issued and there are fewer buyers? Even if the Fed tries to drop the federal funds rate, that only happens if there are enough buyers. And if there is more supply and either same demand or lower demand, my humble thesis is that the rates are going to either hold steady or go up, believe it or not, and not come down. The next 12 to 24 months, this is my thesis, do your homework, is that the government is going to still have huge cash needs to pay off the debt that is maturing. The government may say, I'm going to print money, but that will lead to inflation. And inflation is not good for a lot of things, and you have seen that in the last couple of years. If the government says, I'm not going to print money, that may lead to a recession or even a default. If the government says, I'm going to slash spending, unfortunately, the difference even between the two parties is a small smidgen of what will make a material difference. So either way, we will be raising a lot of money. And if you raise a lot of money, there isn't a lot of demand. My read is that yields are going to continue to go up. Having said that, my 6 month strategy is to just chill. And every treasury that matures, every agency bond that matures, I pretty much buy something that will again mature in the middle of January, end of January, beginning of February, and just sit there and see if there is a compromise. If there is a compromise, yields, in my opinion, will still go up anyway. If there is no compromise, then hey, no problem, I'll pick up some stock. So that is what I intend to do. Otherwise, I'm just T-billing and chilling, but very, very short duration T-bills. Hey, remember to do your own homework. Don't just trust me. Thank you and have a nice day.